Welcome back to this week's market update. Today is Friday, September 29th, 2023, and we have an exciting week, so we'll jump right in here. This week marked the close of the month of September, and historically, September is usually a pretty weak month for stocks, and that trend definitely followed through this month as equities suffered. As of close on Thursday, September 28th, the 10-year U.S. Treasury yield gained about 10%, while the Dow Jones Industrial Average fell 3.3%, the S&P 500 fell 4.8%, and the Nasdaq Composite fell about 5.9% for the month. The most notable catalyst of this drop you can see around this part of the month was the Fed meeting, where we had the Fed expecting rates to be higher for longer, and that surprised a lot of investors and was a primary cause of this drawdown in the later half of the month. Heading right into our economic updates of the week, September's Consumer Confidence Index slipped for the second month in a row, down to 103.0. So you can see that slip here over the last 2 months. This month it was down 5.2% from August index, so quite a bit of a drop. And consumers' responses to the index largely reported that the higher gasoline prices, as well as the political uncertainty of a possible government shutdown on Sunday, October 1st, as well as the pressure of higher borrowing costs, led to this lower confidence index. You can see here that we really have not worked up to the pre-pandemic levels of consumer confidence. Got close to it here in late 2021, but then ever since then, we've been on a little bit of a downward trajectory as the Fed is hiking rates. Also in this index, we saw that the share of respondents reporting that their current family financial conditions are good has also fallen, while those who reported that their family finances were bad has risen. So really interesting stuff. The consumer is losing a little bit of confidence in this economy, and we'll get into that a little bit more in the next slide. Like I was just saying, consumers are feeling less confident in this economy. And one data point that we saw that really confirms this is that revolving credit, which includes things like credit cards, home equity loans, personal lines of credit, etc. Basically, the things that people choose typically not to use. It's not like a mortgage, it's not a car loan, it's not like those big purchases, it's more day-to-day financing of things. Revolving credit increased at an annual rate of 9.2% in the most recent report of July. So consumers are borrowing more and they are feeling less confident in the economy, according to this data. On through our week, August new home sales came in almost 4% lower than expected this week at 675,000 new homes sold in August. The median sales price was 430,000, and this left only 436,000 new homes for sale on the market as of the end of the month. New builds have really been a significant source of supply in this really tight market, and so fewer new homes being sold is not great news for those hoping that the real estate prices might settle down in the near future. With this continued limited supply, residential real estate prices will probably remain pretty sticky, as those with lower mortgage rates who bought at those lower prices pre-pandemic and right after the pandemic stay in their home longer than maybe they had planned to. So lots of stickiness in the real estate market, and we saw this week through new home sales. Next, this week, we got durable goods orders for the month of August here, came in much higher than expected at 0.2% in the midst of a slowing manufacturing sector when we look at other data points like the PMI and other aspects like that. So after a notable drop in July of 5.6%, economists were expecting this month to be negative. However, this better than expected reading on durable goods does shed some positive light on the manufacturing sector. Much of the growth in new orders here stemmed from defense purchases along with machinery purchases, which both drove up the total monthly increase in new orders. We look forward to continuing to watch the manufacturing industry as we kind of tilt in and out of certain sectors in our portfolios, and just also have a really good grip on the total macroeconomic perspective that we're holding. Final update of the week coming in on Friday morning, we got the August PCE inflation report, as well as the personal income, spending, and savings reports for the month of August. Headline PCE came in at 3.5%, pretty much as expected on an annualized basis, and this was up slightly from July's 3.4% headline PCE inflation rate. Then looking at core PCE, we got 3.9%, which was actually the first sub 4% reading on this metric since 2021. So made a big move there in breaking that 0.4% inflation. And again, this is kind of like what the Fed prefers the most in core PCE as their core metric of inflation because it excludes volatile energy and food prices. Also, when we look at PCE kind of broken down into the goods versus services, we saw that on a monthly basis, goods fell 0.2% month over month, while services increased 0.2% month over month, which ultimately led in a headline and core reading of a 0.1% increase month over month. Final report of the week, we got the personal income, spending, and savings report, like I was just saying with the PCE report as well. We saw that personal income increased 0.4% for the month of August, while personal spending rose 0.4% alongside it. So an increase in income, but also matched with a increase of spending. The savings rate fell again in August to just 3.9% of disposable personal income, which again is not great for the consumer in the midst of a lot of uncertainty in the economy, as well as that higher credit usage that we saw in a few slides ago. This month's report demonstrates again that the consumer is starting to feel the lagging impacts of those higher interest rates as they spend a higher proportion of their income, save a little bit less, and are feeling a little bit less secure, as we saw in the consumer confidence survey. So lots of stuff going on for the consumer. Maybe this is a shift starting in a little bit of bearishness that we're seeing in the economy, but in any case, we will continue to monitor the data closely. So as always, we appreciate you tuning in and we look forward to seeing you next week.